Hey everyone, this is Dave Bodamer, the host of Wealth Management Invest. I'm just here to give you an introduction to this episode. It's a special episode. We recorded it live at the Morningstar Investment Conference in June, a couple of weeks ago. My guest was Jack Shannon. This episode was recorded in front of a live audience, and I hope you enjoy the conversation. So thanks for tuning in, and then we'll be back with our next episode with another interview fairly soon. All right. Hello, and welcome to the Wealth Management Invest podcast recording. I'm David Bodamer, the head of our investments coverage at wealthmanagement.com. And we are, for the folks at home, we are recording this live from the Morningstar Investor Conference in front of a live audience. I want to thank my guest, Jack Shannon, for joining. And if you want to take a second to give your title and introduce yourself, that'd be great.
Yeah, I'm a senior analyst on Morningstar's manager research team. So day to day, I cover active equity strategies, rate them, do sort of independent research on just sort of active management overall, and any sort of associated type work.
I'm going to take advantage of the fact that I've got 50 minutes with you to pick your brain on a number of topics. I want to start with a discussion of active ETFs. You chaired a session here about that. I've done a lot of research on that, and then we might pivot into some of your other work that you've done this year. You've got some really meaty reports that you've written that we'll put in a link to the show notes. So folks can check those out. But we'll want to ask you some questions about that. But just to start, I want to start even super basic, which is, can you just define active ETFs as distinct from passive ETFs?
Yeah, so an active ETF is an actively managed portfolio within the ETF wrapper. The key distinction is between a mutual fund and an ETF is obviously just the way that the cash flow works, where in a mutual fund, you're going to the fund company, you're paying NAV when you're transacting. In an ETF, you are, you're obviously transacting in the secondary market, and you're subject to paying, a bid-ask spread. And so that's the mutual fund and the ETF. But when you think about the passive ETF versus the active ETF, the passive ETF is going to rebalance, maybe 4 times a year, whereas an active manager is, I theoretically trading every single day. And so when they're trading every single day and you're disclosing your holdings every single day, at least in a fully transparent version, there starts to become some risks or concerns of front running. And, if the market knows what positions you're in, what position you're trying to get out of, can someone take advantage of that and sort of eat away your alpha? And so you've had these, different kinds of active ETF structures, that semi-transparent, fully transparent. But ultimately, the difference between the active and the passive is that one is active and one is passive, and so there's just higher turnover in the active, and there's different things they can do to efficiently make that work, which we can talk about with like custom baskets and heartbeat trades and all that. But that's sort of the basics. And
from an overall ETF asset level, the majority of assets remain in passive, but active is a significant growing portion of it. And from a launch perspective, is it true that we're actually seeing a lot more active launches at this point than passive?
Yeah, you can take a walk around the floor here, and you'll see a lot of booths hawking, their active ETFs. It's a big point of emphasis for a lot of firms. A lot of the major firms are either have launched in the past couple of years or are getting set to launch active ETFs. They view it as a growth area. Active management has been losing money for decade plus, and this is one way to maybe try to combat that and say, well, if we offer a more tax efficient vehicle, will that maybe keep the money in our pockets a little longer, or maybe even hopefully attract new money? That's the idea, and so you're seeing a lot more in that space. My day-to-day job, I'm speaking with asset managers and portfolio managers every day, and we hear firms tell us, we don't expect any new strategy to be launched in a mutual fund. We're going to only launch active ETFs going forward. I think they're being a bit hyperbolic when they say that,
Mm-hmm.
but it's still like, I think they're telling us something with that, in that active ETFs are going to be sort of the preferred vehicle of choice for active portfolios in the future.
So one question that you threw to your panel is that if you look at the overall assets, if you're comparing it with like passive ETFs, a decade ago or so, the balance between mutual funds and passive ETFs, most of the assets were in mutual funds. Now it's kind of a 50-50 split. On active, it's still, I think, only like 4 or 5% of the assets are in active ETFs. But, could we see that same balancing occur? And your panelists, I think, hedged a little bit on that. But I wonder
what panelists didn't really answer. No.
Yeah, but what do you think about that?
I think so. Yeah. So the stat was it took 10 years for passive assets to go from 4% in ETFs to 50%, and today there's about 4% of active assets in ETFs, so 96% in mutual funds. And so the question is, can the active ETF cannibalize the mutual fund assets to the extent that it happened on the passive side? I don't necessarily think so, because a lot of active money is locked up in these big mutual funds, and you don't see a lot of firms willing to do clone active ETFs. So if you're in a fund that you love and maybe it has $20 billion in it, and the firm wants to launch active ETFs, but they're not going to necessarily launch a clone of that strategy. It's going to be maybe an adjacent strategy, but it's not going to be that one. And so if you're the investor, you have to think, well, do I want to take my money out of this and put it in something that I don't necessarily know all that well? I think that's a different question than it's a passive fund. You're getting the index either way in a mutual fund or an ETF. Whereas in active, the product suite is not necessarily identical when you're moving from active to, or from mutual fund to an ETF.
So another stat that I wanted to throw at you is, this is from Fuse, but since 2012, they found that 16% of active mutual funds and active ETFs had reached a threshold of 500 million in AUM within 5 years of launch. So I guess wondering, does that figure mean anything? Is 500 million kind of just a random threshold to be measuring? What do you make of that stat?
It's a threshold that is important on a lot of to get your fund on a platform. So I know a lot of platforms, they want to see organic assets, so they don't want to see seed capital in it, and so they want to see like 500 million of real client money in a product before they'll put it on their platform. So I think that's probably maybe what that stat is getting at. But I mean, you're going to see a ton of active ETFs get launched in the next 2 or 3 years, and then the next 5 years you're going to see a lot of those close, and a lot of, because it's just throwing stuff against the wall right now and seeing what's gonna hit, what's gonna not hit, and some certainly will hit, some will grow, and others won't. And I think it's sort of a crapshoot to try to prognosticate which ones will hit and which won't. But there's going to be a shakeout period for sure.
Well, and to your point, Morningstar data that you guys have put out was, you counted 571 active strategies in 2023 that were launched, but at the same time, 436 others shut down. So, and I think I'm probably, from a coverage side, very guilty of this too, just paying a lot of attention to looking at the launch side. When stuff closes, people aren't putting out press releases and sending it to us. And so I don't really have as much visibility as into what is going into the ones that don't make it. So,
right.
So
there are a lot of shops that are just, we'll just, whatever the hot trend is of the day, they're going to put a product out there to meet it. And so it's trying to catch sort of fleeting fad money. And so a lot of those launches and then subsequent closures are a lot of that kind of thing, where it was like, go back 2 or 3 years ago and you saw like the work from home ETFs launch, and those are all closed now. The WFH ticker is, right. Like there are a lot of firms that will chase those dollars, and it's it's just not sticky money. It's just because they ultimately aren't really compelling investment strategies.
Yeah, so that was going to be a question there. So in terms of what categorizes the ones that don't work, so in a lot of cases, maybe they're just chasing a fad as opposed to a sustainable investment thesis.
Yeah, it's fad chasing on one end, and then the other is just like if you're a firm and you just throw out a large blend active ETF, it's like that space is so crowded as is. How is that going to really get enough assets to be viable? But it's with active ETFs, it's you kind of have to play in the large cap space, because if you go too far down the market cap ladder, you run into the capacity issues and liquidity issues that you can manage a bit better in a mutual fund than an ETF. Mm-hmm. So there's sort of a natural skew towards larger cap with active ETFs. And once you go into that skew, then you're going into the very highly competitive world of large cap, mutual funds and ETFs and all that, where it's hard to sort of get assets from somebody else there.
And from a performance side, I mean, one way to measure these, which we were talking about, is AUM, but also actual performance and other what are they delivering in terms of alpha? What are they delivering in terms of tax benefits? What categorizes the active ETFs that are successful and the ones that aren't?
It's hard to say. So the most successful active ETFs have been like systematic shops. So like Dimensional Fund Advisors, Avantis, these shops that are like, these are they're quasi-index funds. They're holding 2,000 stocks in the portfolio. They're tilting to value. They're tilting to small cap. But it's really you're getting just broad beta exposure, and so those have gotten the bulk of the assets. And like the pure, true concentrated stock picking active portfolio, those largely have not garnered much assets. Not nearly to the extent that those shops have. So I think there is just some hesitancy from the market, and just like there's not a long track record on any of these to know, like, can you successfully run a 30 stock portfolio in an 30 stock active portfolio in an ETF wrapper? There's like no really track record of anyone doing it. ARKK is like the only one. Uh-huh. And that looked good for a little bit. But that track record hasn't looked great since 2021. So there's just I think there is still a wait and see element to some of it, of like, how can you really manage a tight portfolio in an ETF?
And another thing that's come up in recent years is this question of transparent versus semi-transparent. Like, some ETF managers not wanting to give away their secret sauce, or, just, like putting up a product, saying that we have a manager reputation. This is, you should, I'm probably not articulating quite why they're doing this, but can you just chime in on like the transparent versus semi-transparent and why it's kind of played out the way it has?
Yeah. So the difference is, in fully transparent, you have to disclose your holdings every day. And so the market knows exactly what you're doing at least on a 24-hour basis. Semi-transparent, you don't disclose every day. And even the sort of authorized participants, so the market maker behind the scenes doesn't even know the true extent of the portfolio. And so the reason you would use a semi-transparent is if you're worried about front running and you're worried about, leakage and all that. And so when you saw the first batch of active ETFs hit the market, they were mostly semi-transparent because they were mostly clones of existing mutual funds, mm-hmm. where the mutual fund managers are, portfolio managers overall are a pretty paranoid bunch. And so you talk to any PM at any of these firms, and like they were very worried about front running. And so the first iteration was semi-transparent, didn't really get a lot of assets. And so now you've seen the next wave of the last couple of years is fully transparent, but they're not clone strategies. They're sort of, they're adjacent. You might have MFS is launching some active ETFs in the coming months, a large cap value strategy, but it's not MFS value, which is their core large cap value strategy. It's something like it, but not quite that. And so there is still some concern of like, you don't want to, give too much information on sort of how the mutual fund is trading. And so I think the reason why you've seen the fully transparent take over is because, it's like, again, it's DFA and Avantis, which are 3,000 stock portfolios. They're not worried about,
right.
They're not worried about you front running them because they're not trading specific names. They're trading characteristics and that sort of thing.
Right. So there's this cloning, the idea of, taking existing mutual fund and, reproducing an ETF wrapper. And then there was also some cases of conversion, right? Of like people like actually trying to go through the process of taking an existing mutual fund and converting it into an ETF. But by and large, these are not the dominant ways that we're seeing for launches at this point.
No. There are like DFA has been pretty successful in some conversions. I think on my panel we talked about ETF as a share class idea. Vanguard has it. They have a patent on it that's expiring, and
right.
But so we'll see what happens there. But it's DFA on the conversion side, and that's really about it.
Yeah, and in terms of that dual class structure, you've definitely got a whole bunch of asset managers who have raised their hands, and have filed and are interested in doing this whenever the SEC allows it. But when that's going to happen is still a little unclear, correct?
Still unknown. There's dozen and a half, 24 firms lined up to get in line to do it. There's like obvious benefits to why you'd want to tack on the ETF as a share class because it improves the tax efficiency of the whole portfolio. Like, so even the mutual fund holders would benefit on a tax from a tax perspective if you have the ETF share class. But we'll see when that actually happens.
Right. Well, it seems like the SEC has been busy this year with the approval of the Bitcoin ETFs, and now Ether seems like it may be coming down the pike within the next few weeks.
I don't have a plug in the SEC office to know for sure, but
their mind seems to be a bit on crypto when it comes to ETFs at this point. So I would like to pivot to some of your other work that you've done this year. We talked to so one of the pieces that you wrote was called "Mutual Fund Managers Are Wrong More Than They're Right." So could you just start with I'll just throw out one of the things from it, which was over a 10-year period, only 10% of mutual funds saw more than half of their stock picks beat the index. This means that 90% of funds picked more losing stocks than winners. Can you, talk about that point, or just talk in general about what you were trying to find out when you did this research?
Yeah. So the research was to find out like batting averages for active managers, like how many stocks that they pick actually beat the market over a given period. I chose 3 years because 3 years is essentially the average holding period of like a large cap strategy. Like average turnover is 33% in the fund. Call it 3 years. So I looked to see how many managers over any given 3 year period, how many stocks in their portfolio beat the market in that period. And so the broad question is, we all know that active has trailed passive. The question was, are they trailing because they're inherently worse stock pickers, like they just can't pick enough winners, or are they trailing because they don't weight their winners correctly or efficiently? And then, of course, fees. But separating fees out of that, is that's a main driver for why they don't. But so anyway, I looked across a bunch of different categories to look at it, and it varies what category you look at in terms of like what the hit rates are. But like broadly speaking, if you're looking at a large cap, U.S. equity fund, across any given 3 year period, like 40 to 45% of the index constituents will beat the index over those 3 years. And then you look at the active managers, what were their hit rates? And it was actually centered right around the same number, and actually slightly positive. So they are actually picking more winners than the market as a whole. So basically, if you owned a passive fund, you would have had, say, 42% of the holdings in that fund would have beaten the index over a given period. If you own the active fund and the median, it would have been like 45%. And yet, even with those numbers, the vast majority of the active funds still underperformed. So that pointed to a very obvious issue, which is you're picking more winners, but you're not weighting them appropriately. Your winners are weighted smaller than your losers. And so that's like particularly pronounced in large growth, where large growth managers actually picked a lot more winners than a passive fund would have, but they underperformed massively because they didn't weight their winners at the same rate that, say, the market did, where Nvidia or Microsoft or Apple was 10%. And yeah, the manager picked it, but he had 4% in it. So that was the gist of the article.
And so, but these are the broad averages when you looked at everything. Was there any difference when you kind of tried to like break out by quartile? Were there any managers that kind of were at the top of this?
So there was so then the question was, well, there are some managers who see, so I guess first is there a relationship between hit rate, batting average, and fund success? And in like mid and small cap, yes, it's because again, those are sort of, they're not top heavy indexes. And so if you hit a higher percentage, chances are like your position sizings could actually be in your favor. But in large cap, especially large growth and large blend, where it's so top heavy, the R squared of your hit rate versus the excess performance was like, it was zero. It didn't have any impact. And so then it's the question of, all right, we know there are some good ones. Does it persist? Does anyone stay a good stock picker? And I found no, they don't. It's just sort of random noise at any given point. And you can look, there's a chart in there that shows, it breaks out each manager by decile in terms of their batting average, and then looks 10 years later at the batting average. Are they still good stock pickers? And it's like a pure even distribution and totally random if they were good or not. The only one that maybe has a correlation is bad stock pickers seem to stay bad. So it's the good ones don't stay good, but the bad ones show a little bit more persistence in staying bad.
It's probably, doesn't sound great.
Yeah.
So what is the takeaway for, an investor reading this kind of analysis?
So, my takeaway for the investor was just like investing is hard. It's not easy to pick winning stocks. Like these are managers who have unbelievable amounts of resources. They travel around the world to meet with company management. They have every data feed you can imagine coming into their computers. They have a, floor full of analysts who are, sector specialists. They have risk team who's doing all the factor analysis on their portfolio. And they have all this, and yet they all still can't seem to pick stocks really any better than the market. And so if you're going to try to do it on your own, you're at a pretty big disadvantage. And it's, you might hit it big. I have one of my dad's friends growing up. I was golfing with him the other day. He told me someone told him to buy Nvidia 10 years ago, and he's just owned it since then. And now he's sitting very pretty. That's a one stock portfolio he owned. So it worked out for him. But right. For everyone else who wants to like sort of build their own portfolio, it's a tall task.
So sorry. Another article that you wrote more recently, you published a month ago, you looked at this closed-end fund, the Destiny Tech 100 DXYZ, which has been buzzy. It's built around the premise of giving investors exposure to startups like SpaceX and OpenAI. But you took a look at this and took a look at some of the metrics inside and found some interesting things. So can you also just talk a bit about this? Why you looked at this and what you found when you kind of looked under the hood?
Yeah. So Destiny Tech 100 DXYZ. It's a so I did a bunch of work on private equity and mutual funds for a couple years ago, and I still do it. But so I'm sort of the private equity guy on our team. So DXYZ got on my radar because it is a close-end exchange-traded fund that promised to give everyday investors access to SpaceX and OpenAI, and I think Reddit was in there at one point. All these privately held companies that for so many years, VC and PE funds did great because of low rates, but they did great, and then everyone was like, why can't the everyday investor get access to it? And so you have some of these products come out which are supposed to give everyday investors access. And so like a third of the fund is SpaceX shares. But it got on our radar because it was trading at 20 times its NAV. So the stated value of the portfolio holdings from the fund company was like $4.80 or something like that. And it was trading 20x that at one point. So people were essentially saying, I think your valuations of these companies is off by, exponentially. And so what I wanted to do was just basically tell people, you're trading $20 for $1 because this is, they're telling you they think it's worth $4.84. And, you're paying, again, 20 times that. So we wrote a piece just to sort of warn people about, when you're trading an exchange traded fund, you're doing it on the secondary market. And so you don't get the traded NAV like you would a mutual fund. You have to pay the market rate. And so there's, a litany of liquidity risks with it, and some other things. But it was just it was a word of warning to investors. It's still trading at a pretty thick premium to its NAV too. It's not nearly 20x anymore, but it's like, I'll have to check. It's closer to 3.
And is this like an outlier situation, or are there other funds that are have this kind of profile?
So the access to private equity in like a liquid vehicle is there's not a lot of them. Like ARK Venture, which is an interval fund, but interval funds are not the same kind of closed-end fund as this one, because an interval fund, right, you can, there's quarterly liquidity events, but you're not guaranteed, if you want to sell, you're not guaranteed to actually be able to. They'll say we'll buy back a certain amount every quarter.
Right, like 5% a quarter typically.
But if there's more than 5% who want to redeem, then someone's getting, holding the bag.
Right.
And so there's those interval funds. There's not many of these close-end exchange traded ones, especially in the equity space. There's the close-end stuff and the private stuff is more. There's a lot more in the private credit side of things than in equity. But I focus on equity, and so there's like the private shares fund, which is, I think, Liberty Street maybe offers it. So there's a couple, but it's few and far between.
Yeah, so interval funds have come up a lot throughout this conference, and Morningstar just put out a fairly robust guide to interval funds. I find it interesting, there's been a tremendous amount of growth. We're seeing at least one new fund a month. I mean, I know there's probably a couple dozen that are working their way through the, that are in the registration process. I think, as you just pointed out, a lot. There seems to be some gravitation towards private credit as like the dominant asset type for that wrapper. But I don't know, do you have other thoughts on just the development of this as a model? And so most of the flows into these, my understanding from Brian Moriarty, who was one of the authors of the report, is from RIAs. Interval funds are largely being used by RIAs to access some of these illiquid asset types, and predominantly private credit, which is really hot right now. But so how does that overlap with your research, and do you have any thoughts on the development of this, the proliferation of these alongside of ETFs and other, wrappers?
Yeah. So if you talk with other asset managers, so we're getting back just the discussion on active management overall. I think within equities, a lot of different shops, one particular that I cover, they want to stop offer, or they don't want to stop, but they want to start offering, sort of private public combinations portfolios, because they feel that the sort of public equity market has been picked over. There's not necessarily a tremendous opportunity to grow assets as just a pure public equity manager. But if you can have whatever, an interval fund or any sort of maybe even a private fund, whatever kind of structure you want to use to be able to give clients sort of a hybrid portfolio of like, here's some public, here's some private, I think there is a lot of momentum from firms to do that. I don't know when those will hit the market or what form they'll hit the market, but like I'll give you an example. Like I cover Artisan Partners. They have a fund called China Post Venture, which is a private fund. It's not an interval fund, but it's explicitly this. The CEO has told me in the past he wants to do more public-private sort of hybrid portfolios, and so this is like the first in that vein where it's a PM in China. She invests in like small growth companies in China, but like ByteDance is in the portfolio. ByteDance is the parent company of TikTok. It's privately held. But that's, I can easily foresee a lot of shops going down that route, especially in an interval fund format, just because you can't have daily liquidity with private equity specifically, because I might be getting into the weeds here, but like trading private equity or private company shares is very difficult.
Right.
Like the startups themselves basically control the market, and so if the startup doesn't want you to trade their shares, they have the power to veto your trade. So your liquidity is up to the board of the startup company. So I think it's difficult to do it at scale. These startups don't want random people being shareholders, frankly, because they don't want to have to start disclosing things to you. And so you end up with like, what I could see happening is, which is already happening, is if you want to own, say, shares of SpaceX, like you end up owning a share of like a special purpose vehicle that owns the shares. You don't own the shares yourself. You own shares of the SPV, and then that SPV might be owned by the fund. And that might be how it works, but it's going to be, I think there's going to be a push towards it, but I also think there's just some natural constraints that's going to stop it from being like super big.
Oh, I mean, and what kind of investors are these things open to?
Well, an interval, like there's always like the qualified investor issue, which is like all these funds are trying to like democratize access to everyday people. I just think that it's hard to democratize. Like there's just so many sort of constraints at the actual company issuer level, if you want to call them issuers, that it's difficult to do. And so, I think that like the qualify, like the $250,000 limit or minimum for being a well-informed investor or whatever, I think is a little blunt. And I think you probably could do some sort of education test or something to see if someone should be able to have access to some of those products. But it's bringing private equity and private credit and these illiquid assets to the masses is just super difficult because they're illiquid.
Right. It seems like part of the finding of that report was that private credit does seem to work because it's you can sell it easily enough to probably meet that 5% liquidity requirement, but like a private equity share, if you're that's going to be much harder to move. I know there's some real estate that's in interval funds. There's other asset managers have tried some other there seems to be some process here of like trying to match up the proper asset type with the proper wrapper, to deliver it to the masses. But whether this all is really the right thing to be doing is, I guess, to be determined. Is that fair?
Yeah, and it's there's just like the liquidity is just it's the hardest thing to overcome. Like I said, it's controlled by the startups themselves. There are like platforms out there. I've talked to a few of them that start these exchanges where you should be able to, where you could trade. You could trade your private equity if you wanted, but like no one wants to buy. There's no liquidity on the downside in private companies. Mm-hmm. There's like SpaceX. There's tons of liquidity right now because it keeps getting higher valuation, and who doesn't want to buy it? When a private company starts going down, though, there are no buyers. There's zero liquidity on the way down, and so that's the real, I guess, the real issue on the equity side.
What else? Is there any other themes just in terms of either private equity side or active management that are kind of top of mind for you?
So within, I guess, so there, go back like 10 years, like it became pretty popular for a lot of sort of the bigger firms to start having slugs of private companies in mutual funds. And so with mutual funds, you can have, 15, the SEC limit is 15% in illiquid assets. And so you'd see some funds butt up against that limit, like Barron Partners, which is, Ron Barron, who's a big Elon Musk fan. Big chunk of that portfolio is Tesla. Another big chunk is SpaceX. It's like 13% of the portfolio. And so what's interesting, though, is we've talked with folks at some of these mutual fund companies, and the enthusiasm for having private equity in mutual funds is deteriorating pretty significantly. And I think the reason is because we just talked about, for a long time, private equity and venture capital looked phenomenal, and it kept going up and up and up and up. And then 2022 hit, and some of these companies blew up. Juul the FDA shut down Juul. And so that went from literally some of these like American Capital Group bought it and then wrote it down about 99% within a very short period of time, because that's when the FDA shut them down. You have, just a bunch of these, delivery startups, a lot of these hot COVID era type companies that saw, valuations peak in 21 and early 22 and then just collapse, and they haven't recovered since. They haven't raised more money at higher valuations. And so I think the shine has come off private equity a bit. And so you're not seeing, mutual funds actually being more, getting more into it than they were before. And in fact, you see them pulling out a bit.
And do you have any other research that we should be looking forward to for the second half of 2024?
Well, we'll see when it actually sees the light of day. But I think we spoke about it before. Just as a test for active management skill, and you've all heard, I'm sure, the monkey throwing dart, Wall Street Journal study. I've been recreating that study, but in a different way. And so, like the Wall Street Journal, the way they would do it is throw the dart. A year later, throw another dart and, create a portfolio that way. My idea was just randomly select 50, 100, 150 stocks at any given point and don't touch them. Just buy and hold for 20 years and run that over and over and over again. Do 1,000 iterations at every day and just see the distribution afterwards. And what you often see is that the random do-nothing portfolios are distributed to the right of the active management portfolios. Now, that doesn't mean they beat the market. Usually it's centered right on the market, which is kind of what you'd expect.
Right.
But it's, it's not necessarily a great sign for active managers. But then, the critique of that is if you do nothing, you risk, well, if you started this in 1999, you pulled a random portfolio and Apple happened to land in that portfolio, by 2024, it might be 45% of the portfolio. And you might say to yourself, well, that sounds extremely risky.
Right.
And so this research that I'm doing is also testing, downside max drawdown in these portfolios. And they're actually, the maximum drawdown is actually lower than it is in like the terms of the distribution is to the right of the actual max drawdowns of active managed funds. So, I think on our team, we're constantly trying to figure out which managers have an edge, which are just producing noisy returns. And I think with this sort of randomness, you can better understand, the skill of a manager, because if say you're a manager who says, I only like buying high quality dividend paying names and I want to see low leverage on the balance sheet, and you have all these criteria. And if you tell me those criteria, well, I can just recreate those criteria, put a couple thresholds, and then randomly select stocks from that universe. and see how a random portfolio from your own criteria would do against your own actual results. And so when we do that, you can get a sort of a better understanding of like, is the manager doing well relative to, his defined universe, or is the universe just sort of the driver of the return?
Right. So this is something that you've got in the hopper, but may or may not see the light of day.
It's been in the hopper for a bit, and it's our research process is pretty thorough in terms of what number of eyeballs that go on it before it actually gets flushed out into the world. So we'll see if it ever sees the light of day. But it's we use it. We still use it like in sort of day-to-day work, just in terms of like, again, like evaluating a manager and evaluating whether or not there's skill. You kind of want to know if it's, if I could just randomly pull a portfolio from the same criteria you use and it does better, that tells me like, okay, you might be using decent criteria, but your selection within that, the execution piece might not be there.
Yeah. And so how big is the team that you work on actually?
So I'm on the broad manager research team, which is about 120 analysts, but that's spread across the world. Then within America, we probably have half of those in America in Chicago. And then on my like actual going down another level, I'm on the equity, the active equity team. There's probably, a dozen and a half of us or so. And so we each cover 40 to 50 strategies. We're responsible for, covering 4 to 5 firms as like the lead analyst on a firm. And, so we have a lot of breadth of coverage.
And just for the folks that are listening to this, probably a couple of weeks from when we're recording, they can find your bylines on the website. So if they just search the Morningstar site, they could find some of your publicly available stuff. Is that stuff like the full versions, or do you have longer? Like, are these like teasers for more blown out reports?
It depends. Some of them are just like teasers of like longer white papers. And then some of them are just standalone, just like I got worked up about something one day and I was like, I gotta write an article about it. Like DXYZ was in like, that's just a standalone article where it was you see something, you're like, this doesn't make any sense, we need to tell the world that don't do this. But yeah, there are some that like there's a private equity landscape paper that's a big, 40 page white paper, but then we have the simpler 3-pager on the website. So easier to digest the smaller ones. So if people want to do that, no skin off my back, that's fine.
Okay. Well, we've pretty much blown through all of the questions that I had. So I don't know if you maybe give the audience a second if see if anybody here has any questions they want to throw to you. Otherwise, we can maybe we can just wrap this up a few minutes early.
All righty. Thank you, David.
All right. Well, thank you so much for your time and for sharing all your insights.
All right. It was a pleasure.
David, how do people get in touch with you if they have more questions?
You can find me at wealthmanagement.com in our investment section, as well as on LinkedIn is probably the best place to ping me if you're looking to get in touch.
Well, thank you, David. And thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.